Modern trading is one of the most highly competitive professional fields that exist. With extremely low barriers to entry thanks to the rise of online brokers, it is estimated that north of 90% of traders will be chewed up and spat out from a margin call within a mere few months of starting out. While 8% will tread water or at best make some money, only 1 to 2% will manage to make on average the equivalent of a regular salary out of it, and less than 0.25% will actually make a killing. It is as close to a winner-takes-all championship as it gets. The one component that keeps that 0.25% rolling for a very lucrative outcome, however, is that they harness the only true free lunch that exists in this game. This video is gonna be a short one, but it needs to be done to cut the crap about all of the bogus hacks and tricks and shortcuts sold to you at face value on social media. So let me break it all down to you and then decide for yourself if you want to keep doing what you're doing and chase pipe dreams until you run yourself into the ground, or if you want to make a radical change for the better to reach the level of those who are actually winning. So let's get to it. The only true free lunch in trading has a name. It's called decorrelation. But what is it really? Decorrelation is a fancy name to express the effect of diversification when and only when the components of a trading portfolio generate asynchronous returns. In other words, diversification is not a sufficient condition to decorrelation, but it is an absolute prerequisite. Diversification only becomes decorrelation when the components of the portfolio generate performance from different sources of alpha that unlock at different times. And no, long and short are not required to achieve decorrelation. When done correctly, the effect of decorrelation is tremendous on long-term performance, and it can be qualified as a free lunch because it grants the best of both worlds in trading simultaneously, meaning higher returns and lower risk over time. Or said another way, the risk-adjusted performance of the blended portfolio becomes greater than the sum of its parts. Practically speaking, you will have to have asynchronous trading strategies working together, side by side, in order to build a robust decorrelated systematic portfolio. However, diversification does not mean either that you will have to have a gazillion different strategies in order to achieve decorrelation. In fact, as it happens, the decorrelation effect of any single extra strategy is log-shaped, meaning that the more asynchronous strategies you add to a portfolio, the lesser the extra marginal decorrelation effect on that portfolio. The good news here is that decorrelation can drastically happen even from 2 strategies, and believe it or not, 3 will be sufficient to be part of the trading 1% if you play your cards well as far as algorithmic design goes. I personally work with 6, but once again, you don't need to in order to win. So for the sake of this demonstration, we will stick with 3. I want to show you here what I meant by portfolio performance that is greater than the sum of its parts. For that purpose, we will assume an algorithmic portfolio of 3 equity trading systems. Now, how and what these systems actually trade is irrelevant to this discussion and will be addressed in another video, but for now, let's just consider that they trade very different sub-asset types on very different time horizons and with very different algorithmic logic. Said differently, they derive their performance from distinctly decorrelated sources of alpha. So let's take a look at their long-term individual stats. Here we can see their respective compounded annual growth rates, maximum percentage drawdown, average percentage drawdown, maximum days in a drawdown, R squared, MAR ratio, Sharpe ratio, and profit factor. Our average theoretical portfolio stats become these ones. However, these are just averages, and that is without counting on the magic of decorrelating when we make all of these strategies click together. So now, let's combine these systems within a portfolio with equal weight allocations of 1/3 each. Look at what happens versus the average stats. Right off the bat, the overall blended equity portfolio is visually smoother than each one taken separately, and as you can see, the only stat that is more or less translating as a straight average is the compounded annual growth rate. But in particular, look at the risk metrics and ratios. Every single one is better by a non-trivial margin, meaning that the trading performance, which is the yield extracted from and normalized for each unit of risk taken, is materially improved across the board. Every single one of these stats has been improved by the mere effect of decorrelation and nothing else. This is what I am describing as portfolio performance that is greater than the sum of its parts. You see, achieving decorrelation is not a nerdy gimmick for the sake of flexing your algorithmic skills. Instead, I want you to understand that this is the essence of trading. This is the missing link to the long-term performance that you've been looking for. The ability to gainfully distort the available risk-adjusted return derived from mere passive investing in the market. In most cases, as a trader, it will allow you to increase your compounded annual growth rate without taking more risk than you would have otherwise taken. And because of that, it is the closest thing to a free lunch as it gets. More reward for the same risk, or the same reward for less risk. It's such a simple concept, and yet it flies over the head of most traders who hyper-focus over maximizing the return of a single strategy. This is where the complexity lies though. To be able to craft the correlated systems that fit the bill of generating highly singular sources of alpha, and therefore to maximize the effect of decorrelation when they are combined. That is precisely what we will get to in the next episode, so stay tuned and I'll talk to you in the next one.